My name's Dave Dubeau, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Hey gang, welcome back. You've probably heard the expression bigger is better, but is it? Is it really always better to do bigger deals? Well, today my guest zooming in is Joe Nolan, and Joe Nolan would beg to differ with you on big deals always being better. In fact, he and his partner like to focus on smaller deals under $2 million. They think that gets them and their investors a better return on investment. So Joe, great to have you. Welcome to the show.
Dave, thanks so much for having me on. And, it's true. Bigger isn't always better. A lot of times.
That's what I've always told my girlfriends. They don't know what to do.
You and me both.
I'm short, man. That's why.
No, I think me and my partner, Aaron, have really hit on something here. We have our small syndication company, Finest Address LLC, and we're both using it as an investment vehicle. Sort of came into being at a fantasy football draft. My buddy is an accountant. I actually helped him get the SBA loan to buy his accounting firm. I'm in finance, and in August of 2020, when the whole world was shut down and I couldn't explain to you why Tesla's worth 120 revenue, but I could point to the duplex I had here in South Philly and say, well, these two doors are earning X, expenses are Y. At a 6 cap, I can tell you exactly what this is worth. Why don't we figure out how to bring in some friends and family and try to make a little bit of money so that, we're not just hoping that someone else makes money for us.
So what these days, what do you and your partner, Aaron, focus on when it comes to your buy box? What kind of properties are you buying?
Yeah, we're looking for deals that we can add density by right, ideally. What
does that mean exactly?
I'll give you a great example. We're working on a project in Merchantville, New Jersey right now. It's like a small 3,500 person borough. There's a main street there that we bought 4 units of suburban office, 2 on the ground floor, 2 on the second floor. By right, ground floor has to remain as retail, but we've got permission to turn the second floor into 4 apartments, 2 2-bedrooms, 2 1-bedrooms, and each one has 2 assigned parking spots. We're in phase 2 of that one right now, where we bought the property for $450, and we just had the appraisal done before we're doing the second 2 apartments, and it's valued at $995 right now. Should be worth $1.2 when these 2 new apartments come online. And that's a 3-year investment horizon.
Nice. So that's obviously you're looking to do more of those kind of deals. What does your portfolio currently look like? It sounds like you started with single families and duplex type properties back in the day. What does the portfolio currently consist of?
Yeah, right now we're focused primarily on 2 to 12, maybe a little bit higher unit. Or ideally getting to that number. So we've got a few apartment buildings across the end of the line for the Philadelphia train stations. And then we've got a few properties that are more just buy and hold here in the city. But we've done all that through our fundraising that we've done primarily through friends and family, using SEC exempt status, filing and raising through our Juniper Square platform. And that's allowed us to make sure that we're not just making money for people that already have a lot. We're actually able to bring along our friends and family as we're unlocking value in our own backyards.
So lots of people would like to be able to do that. Joe, what do you, without getting into the weeds too much, can you give us the big picture overview of how that program works?
Sure. So very high level, we've set up a waterfall structure. So we're using A shares in a special purpose entity. So for example, for that Center Street project in Merchantville, we created an entity. The A shares are owned by Finest Address LLC, which is our syndication company. And then we sold the B shares, which are the equity shares. And the way it's written into the operating agreement is that the A shares have all the management rights, the ability to raise, the ability to refinance, the ability to take on new debt, and to, on behalf of the investors, seek ways to improve the property.
Yeah. So You guys are the ones that are in control of it. You own the primary shares, but your investors have shares as well, and they have certain rights and privileges as well, correct?
That's right. So they're buying the B shares. And what we have is a waterfall calculation that says when we are doing distributions, say it's distributions from cash flow, first we have to pay any taxable event to our investors first. Then we have to pay to our investors. And then if we are able to pay out all of our investors' preferred rate of return, currently 8%, then any future cash flow is split 65 to 70% to our investors pro rata, 30% to the A shares. And if we're doing a larger distribution because of a sale or a refinance, something that has a big event, the waterfall's written so that first we have to catch up that 8% preferred rate of return if any has accrued. Then we have to pay back all of our investors' equity, but that doesn't buy their shares. It just returns their money. Right. So then everything else would be split at that same pro rata rate. So the idea is we set up our structure so that Aaron and I only really make money when we've delivered our promise to our investors, in this case, a 8% preferred rate of return per year, as well as all their equity back. But because we're looking at these smaller deals, you don't need to have a giant jump in order to make these numbers back. So we've been able to, on that property, we returned 50% of equity within 18 months because we were able to do a construction loan with an earnout. So now we're going to do this other half of the construction. Ideally, interest rates keep falling. We'll be able to do one more refinance to take out the remaining equity. And then Aaron and I and our investors are just clipping a coupon of a very well-positioned asset that's 3x in value over a 4-year period. So that's really where I think there's a lot of value in the smaller market. You're not competing with the big guys because it's too small. And the small guys usually aren't sophisticated enough. And especially most syndicators are going to take that 1 or 2% close fee. We usually don't do that because we're just setting this up as our side hustle and our way to grow and invest while we also focus on our main careers. And I think that gives us a big advantage.
Yeah, no, that's a very, very cool way of doing it. Is it expensive to get things set up that way, Joe, or is it fairly cost effective?
Well, it helps that, my business partner is a CPA. So he's very good at being able to create the entities and does all the bookkeeping for us. We use a third-party CPA, of course, for any filings. But, we did have to put money into it. We found a great attorney here in Philadelphia, Alan Nachumson, who helped us on our first deal, and had a service through his law firm that helped us draft up, our original operating agreements, do the initial Edgar filings and everything like that. Mm-hmm. So, my biggest advice is always to build your team because you can only get so far with the idea and quarterbacking it. But you really need to have professionals that can help you navigate through the different waters, as it can really change not just city by city, but block by block.
Yeah, most definitely. So, Joe, what are you and Aaron? Well, let me ask first things first. So, when it comes to raising capital, you're working a lot with friends and family. How many investors? What's usually like the minimum investment that you're getting people to put in? How many investors, for example, in that deal that you're talking about? How's that side of things typically look?
Yeah, the earlier deals, we were a little bit more forgiving with a $10,000 minimum. And, we did let some people in for $5,000. But as we've sort of grown.
Sounds like you're doing nice things for people, but an absolute nightmare.
No doubt. But it was also, you got to. Our thought process was if we walk away from this deal breaking even, but having learned, then this is a home run. So, having to learn those lessons along the way by going and learning how to do the addendums and all the paperwork and the sophisticated investor questionnaire is good to know. But it's been a real journey from there to get to the point where $25,000 minimums is really what we're asking for because our most recent raise was $750,000 to go buy 7 units on a $1.3 million purchase. It's definitely an overraise, but we were able to get the sellers to hold a 6% interest only note for 10 years.
Nice.
and that allowed us to bring in too much equity. But the beauty is that building is very underutilized. So we're currently going through the upzoning process to allow us to add additional density in another downtown area. But the idea is definitely grown to try to bring along people with us. We don't go to private offices. We're not going to family offices. We're not looking for these big checks, where you need 7 figures. Our entire raise is less than 7 figures. But the idea is that we have a process where, in these $1 to $5 million deals, you can bring 50 to 60 investors in that are all bringing 20 to 25,000, sometimes more, sometimes a little bit less. But you can unlock a lot by being the quarterback for the people behind you. And it's been a hard trust to earn. We've brought 2 other deals along pretty far. We had money raised. We spent money on reports. One deal we had to walk away because there was just, it doesn't matter. There was 40,000 already spent on reports and legal work. We realized that we would be doing not just ourselves, our investors, a disservice. Yeah. But when you do that, you buy a lot of people picking up the phone the next time you bring them a deal.
Hey there, if you're a capital raiser, a syndicator, or a fund manager, and you're looking for a steady flow of incoming accredited investor leads, then go ahead, grab a free copy of my new book, How to Get 20 Accredited Investor Meetings Every Month Without Cold Calling, Networking, or Chasing People. You can get that at 20accreditedinvestorsbook.com. Again, that's the number 20accreditedinvestorsbook.com. Yeah, most definitely. Smart stuff, Joe. So what is the exit strategy for you guys? It sounds like you're kind of long-term buy and hold.
Yeah. We like to say that once you have assets, you have options. Mm-hmm. I think that there's a cap rate compression play by turning this into a portfolio of similar assets in a geographic area. If we were operating at them and, doing the hard work of bringing them up into standards, we can sell a portfolio of 50 units for probably more than we could sell each of them individually. But each individual asset is buy, improve, refinance, and hold. So almost the Burr method, but the important part for us is that every deal has to make sense. Every deal has to pencil. And then the goal would be if we just clip the coupon forever, then we all walk away happy. But if we get to a point where there's a better option, that we can take it.
And you and your partner basically have the say on that. You don't have to get the okay from your investors, correct?
That's right. I mean, we have to go to them if we're going to do things like actually raise capital, anything that would be dilutive. But in terms of the actual management of the asset itself, it's written that for our investors, it's a true passive investment. And we only are able to earn our advisor fee by executing the strategy that we laid out to them.
Very good. So, Joe, we're coming up on the end of 2025 already. My goodness. What are your plans for 2026? Where do you see yourselves taking the business?
We're hoping that with the interest rates coming down and some of the new construction relationships we've made, that things that have just been sitting on the shelf will come off, blow the dust off, and get some projects moving again. Mm-hmm. Hopefully, the market on freezes a bit. It's everyone's sort of got record high rent rolls, but people are coming to them and trying to buy properties for what they bought it for 5 years ago. And, it's just a frozen market on the open market. So we're looking very opportunistically for value add plays in the Philadelphia, South Jersey markets, as well as the Austin to San Antonio market, where my partner Aaron is based.
Okay. Yeah. So you got 2 different markets that you guys can be going after. Very, very interesting. So with all of this experience, raising capital, working with friends and family as your investors, what have been some of your biggest takeaways so far?
That honesty is just the only policy. If you can't just be completely transparent with what you're doing to your investors, you're doing the wrong thing. And by being that kind of radically transparent, you never have to remember what you told anyone. You just keep telling everyone the truth.
Well, that's easy to say. What's an example of a not so pleasant thing you've had to share with your investors that actually turned out to be a blessing in disguise?
Yeah, I mean, the best example is when we had we were going into our second deal. We were doing a purchase of a ground floor co-op that was a supermarket with 8 apartments above it in Philadelphia, brand new construction, and we had about $1.3 million circled. We were going to do a Freddie Fannie loan. We were still deciding, and it was going to be a giant step up, almost triple what our previous deal had been. We got really far in the process when our study, the property condition report, came back showing that the stucco had been applied improperly. And when we
brand new building.
And when we went and did the investigation of the property, I remember looking and seeing daylight when I was able to look up through the stucco. I'm like, well, that's not a good sign. There was already a leak in the supermarket. So, we had negotiated really hard, but essentially we got to a point where everyone was telling us it's going to cost you $300,000 for us to tell you what it's going to cost to fix this.
Oh my goodness.
That's just the minimum to take it off and put it back on. And who knows what we'll find when we take it off. And this is a $2.6 million property. So, Aaron and I tallied it up. It was probably $40,000 total money out the door. We had to go call all of our investors, tell them, hey guys, listen, we could do this. They're offering us some money to do it. But, Aaron and I had a real candid conversation with each other and just said, listen, if we're wrong, we can't go back to our investors and say, hey, that thing we knew about before closing, turns out it's going to cost more than we thought. Everyone's got to add more equity. Yeah. That's the end of our careers. So, being able to, it was a series of long calls. I mean, I remember when I finally ended that deal, the broker told me, you'll never do another deal in this city again, and I'll make sure of it, because we were walking away. Yeah. So, you just got to always do the right thing. And, if you're doing the right thing, you tend to have a lot more shots at the apple. And then when you do get that good chance, you can execute.
Did that jerk of a broker end up eating his words?
Well, I've done a lot of other deals since then, yes. But he's gone on to have a very successful career. So wish him nothing but the best.
Yeah, sometimes you can't win with people like that. Joe, this is good stuff. If people would like to find out more and connect with you, where should they go?
Best way to connect with me is on LinkedIn. I'm jnolan3489 on LinkedIn. You can always go to finestaddressllc.com. And if you ever have a question, I'm always happy to entertain a conversation.
Sounds good, Joe. Well, hey, thanks for sharing what you guys are up to. I love what you and Aaron are doing with how you structure your deals, the entity that you set up, the way that you've got the shares organized, the waterfall. It's just really, really smart. A good way for you to help people who don't have hundreds of thousands of dollars get started in real estate and still be compliant with the Securities and Exchange. I think that's really, really smart.
Exactly right. Couldn't have said it better myself, and really appreciate the chance to talk. Appreciate what you do for the community.
All right. Well, Joe, thanks for being on the show. Everybody, thanks for tuning in, and we'll see you on the next one. Hey there. I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewsyou.com.